right, welcome back, everybody, to our second video episode of Capital Clarity. I realized on the last one that um, I said video, but if you're listening on Spotify, obviously we don't have video on Spotify. I apologize for that. We do have video on our website, and we are hopefully getting YouTube soon. So stay tuned for that. But
That's going to happen.
yeah, I hope everybody had a great holiday season. I know we did. It was busy. It flew by. It's always so much fun, though. But yeah,
Yep.
yeah,
I'm looking forward to you and I are going out to Scottsdale, Arizona soon.
we are. Two
Little-
weeks. We'll
some-
be there in exactly 2 weeks.
Yeah, mix of work with client meetings as well as a little bit of fun. So it'll be a good time.
Yeah. Oh yeah.
Be nice to get warm. I haven't seen the sun in Pennsylvania in a while.
Yeah. I'm sick of I just hate the gray. In Pennsylvania where snow is fine. Snow can get old after a little while, but I hate when it's just gray and muddy and
Yep.
dark.
Yeah, that's what most of the winter
depressing.
feels like here.
It's
I know.
depressing.
I
Yeah,
know.
it really is depressing.
All right, on to
Um,
good stuff.
You kick us off for the new year. First episode of the new year. I just realized the other day, have we been doing this officially for a year now? I think we have. So you kick
Yeah.
us off for our first 2026 chart.
All right. So remember, well, think of it. I was looking at this. The stock market has done so well for so long, but even over the last 5 or 6 years, shorter term, it's done great. And I was thinking, we're always have our guard up for the next decline. And I was thinking, what if stocks fell 30% from here? Where would that take us? So if stocks fell 30% from here. So right, like January 2024.
Can I take a guess?
Yeah, I just said
It
it.
would take us back to January 2024.
There you go. How'd you see? Yeah.
I think
Yep.
you and I read the same article.
Yeah, so I got thinking about it. So you think January 2024, ChatGPT, artificial intelligence was just launched. Barbie and Oppenheimer, which I didn't see either of those movies, were in the theaters.
Oppenheimer, very well done movie.
Yeah, okay.
I didn't see
Everybody
Barbie,
loved it.
but
Yep.
Oppenheimer was great.
NFL playoffs were in full swing. Stock market was at a new all-time high in January 2024, and everybody felt great. Everybody, I mean, we did. If you could teleport back then, you go, things are pretty good in the markets and life in general for most people, right? But if stocks fell 30%, we would be where we were in January of 2024, which to me is simply amazing because it was a really good period of time. So let's see here if I got a little silly chart on this one. There we go. Sorry, guys. There we go. You see that?
There we go. Now we can.
Yeah, so this is a chart of basically the S&P 500 going back to late 2023. And you can see with my crude little drawing there's Jan 2024. The S&P 500 was about 4,700, 4,800. Today we're well over 6,500, closer to 7,000. And it would be really miserable to have a 30% decline, but it would only take us back to Jan of 2024, when in Jan of 2024, we were all pretty happy with where it was. So yeah, I'd hate to see a 30% decline, but it just shows you how far we've come, the fact that a 30% decline would only take us back that far.
I mean, yeah. Were you happy in January of 2024 with the stock market? I would assume so after 2023. So
Yeah,
it's not
Things-
so bad.
things were pretty good.
Yeah. We as humans can have recency bias.
Yeah, that's normal.
Yeah. Okay. I thought this was interesting. I feel like gambling has been a big topic that gets hotter and hotter in recent years. I have this chart here. If you can see that from Creative Planning. Online casinos raise far more tax revenue than sports betting apps. So I've never used an online casino. Money where my mouth is. I have placed the occasional wager on a college football game, but so that's technically a sports betting app. But I didn't realize for more states than this, but at least these 4 states, the amount of billions of dollars that states are raking in from online casinos, from app related casinos. So Pennsylvania, yeah. in
So on
2025. They hit
yeah.
$100 million per month in tax revenue from online casinos. Michigan,
100 million a month. They're running a 1.2 billion dollar a year tax revenue from online casinos just in Pennsylvania alone.
Pennsylvania on this chart was the highest. Michigan was just shy of $75 million a month in tax revenue from online casinos. New Jersey, 50 million a month, and Connecticut just under 10 million a month.
Wow. Yeah, so online casinos are way better for tax revenue than sports betting. Well, it makes sense. I got to assume people are gambling more on casinos online than they're betting on sports books. Because I don't know about you, most people I know who bet on online sports books, DraftKings or whatever, they're betting $50 on some crazy parlay that pays out $800 and it never hits, that kind of thing. But they're not
But
betting 5 grand.
can I just say, this also ties into, gosh, this seems dangerous. And, just for the average person to have a casino in their pocket rather than,
Yeah.
having to enter a casino, go to the table, take money out, get chips, that whole thing. This seems very dangerous. And it also, I think, plays along with having uh, investing apps in your phone, day trading
Yeah.
apps just on your phone. It's so easy nowadays. It's so easy nowadays for someone to hurt themselves financially as opposed to, 20, 30 years ago. 20,
Yeah,
30
you'd
years
have to
ago,
go somewhere.
there were a lot more physical barriers 20, 30 years ago to losing money than there are today, in my opinion.
Yeah, true. It's funny, those online trading apps, the coolest ones, they look like the inside of a fighter cockpit. I
Oh
mean,
yeah.
dials
I don't
and
want to single
levers.
any out, but yeah, they do.
Oh, and they do that on purpose because they want you
Well,
to.
it's called gamifying. They gamify it.
Yeah.
Yeah.
Oh, yeah. And it makes it seem like action is activity equals success. When you and I know in investing, it's usually the inverse. Action usually
Yeah.
is the antithesis of success. So, yeah.
And what a lot of these users, these consumers of these online casinos and investing apps don't take into consideration, that I'm sure the state and federal government are really happy they don't, is taxes.
Yeah. Yeah.
When you bet and win, or when you have a short term gain or any gain in a
Yeah.
non retirement account, you're going to have to pay taxes.
Yeah. Yep.
Yeah.
Uh, so Goldman Sachs back in 2020, we see this all the time, not just from Goldman. I'm just picking on Goldman a little bit. Back in 2020, Goldman Sachs came out and said, the stock, I'm paraphrasing, but the stock market's price earnings ratio, the price of the average stock in the S&P 500 divided by the earnings of the average stock in the S&P 500 is 23. And the higher the price earnings, the higher the PE, the more expensive something is. And they were saying back in September 2020, the stock market's PE is all the way up at 23. It's very, very high. And 23 is high. It's higher than the long-term average, which is right around 16 or 17. And they were saying it's really, really high, September 2020. It means the next 5 years will produce little in stock gains. And Goldman said we might see 20% in total gains over the next 5 years. So what happened? You can see from this image, stocks are up 94% over those 5 years, not 20%. Defying the fact that stocks started 5 years ago as expensive, they still went up a lot. A lot of that's driven by earnings. Earnings have been better than long-term trend, which is wonderful, and that doesn't always last. But it's really tough to take these predictions based on valuation and actually invest based on them. So now what do we have right now? Just in the last week, Goldman Sachs came out and said the stock market's price earnings ratio is 21. Now, 21 is still a little high, but it's still not as high as the 23 from 5 years ago. But Goldman's saying, hey, the stock market's PE is 21. That means the next 5 years will produce little in stock gains. Again, they say maybe 20% over the next 5 years in total. So we'll see 5 years from now. But it's really just a lesson in it's tough to use valuation as a predictor of direction. The market can continue to defy those numbers pretty easily, especially if earnings and margins come in really, really solid.
And anybody who thinks they know what the market's going to do with absolute certainty is wrong. They're kidding themselves. And if they
Yeah.
get it right, they got lucky. It's,
Yeah.
you know, yeah. Speaking of the good old S&P 500, I got this piece from Bolello right here. Sure, we've brought up a whole bunch like it, but basically just showing, listen, 2025 was one of those years we had a pretty rough first 66 trading days. You see it on the rank number 4 there. You see 2025. The price return for the first 66 trading days of 2025 was minus 15.3%.
Oof,
And
that's
then
brutal.
this is the best part though. The price return day 67 to year end was 38.7% to bring the S&P 5 up for the full calendar year of 2025 up 17.5%.
Yeah.
So
This is a great image. I
it's
mean,
amazing.
because
And
if
there
you,
were other years similar. I mean, look at 1938. I mean, it wasn't as big of a drawdown, but look at that return in the second half of the year and the total price return
Yeah.
of 24.5%.
So 2025 started out really difficult. In fact, from this chart you're showing, which is really cool, it was the 4th most difficult start to a year going back to 1928, with the top 3 being 1932, Great Depression type of era, 1939,
World War II.
yep, and 2020, the onset of COVID.
Yep.
So 2025 started off
Look,
brutal.
can I just show you what is next on the list? And we still ended in a rough period for that, but 2001. And, unfortunately, we all knew what happened that year.
Oh, yeah, 2001. Now, yeah, that was the middle
It didn't
of
recover. It didn't recover that year.
Yeah, because that was the 2000 through 2002 bear market that was mostly driven by tech stocks finally having their comeuppance when the 1990s ended. I lived through that. That was a brutal 3 years. I remember at the end of 2002, 3 down years in a row, which is really rare, really thinking, oh my gosh, can we be down in 2003? And we weren't. We were up huge. But how does anybody know that after 3 years of being just beaten down,
But take a look at the 7th rank where the lost decade kind of broke. 2009, the first 66 trading days were down 9.7%. The S&P was down 9.7% in the first 66 trading days of 2009. And then, I'm sure you and everyone else had assumed, oh gosh, this is going to be another terrible year. No, second half of the year driven up 36.7% to end the year up 23.5% and start, I think, a pretty good period in the 2010s of the S&P 500.
That's a great chart. It's basically, I think, obviously the message is whether it's the start of the year, middle of the year, or the end of the year, there's going to be periods of volatility that are going to shake you to your core. And most of the time, you're rewarded, especially over time, for muscling through it. It's hard to do, but that's why stocks have historically returned so much more than most of the other choices we have.
The night is darkest just before the dawn.
Yeah, that's a good way to put it.
That's a Batman quote.
All right, so kind of dovetailing with that,
With my Batman quote?
with your Batman quote, not the Batman quote, with the idea that it's.
Can you guess which Batman that's from?
No, there's no way I'm going to know
Come
that.
on.
I haven't even seen all the Batman, so.
You saw The Dark Knight, though.
Oh, is it the Dark Knight? Well, that's
Yeah.
the best one.
Yeah.
That's if you dispute that, even a Batman amateur like me's got to question your Batman knowledge. Dark Knight is incredible. So, but the idea that it's difficult at times to hold stocks. Check this out from Morgan Stanley. So Morgan Stanley put out a piece that talks about, all right, hey, from 1985 to 2024, 40-year period, what were the best stocks to own, the top 20 stocks to own in terms of average annual return? So over those 40 years, this S&P 500 returned 11.8% per year. But then these 20 stocks returned on average about 19% a year. So about 7% a year or so more than the S&P returned. And the whole list is on the screen for those who aren't watching but listening. Amgen, the biotech company, I was surprised at this, but was the number one over those 40 years, up 22.7% per year. But let's go to number 2, which is Apple. Apple returned 20, and nobody's shocked, right? Apple, everybody loves Apple, right? Apple returned 21.6% a year, almost doubling what the S&P returned over that time. But if you look at the next column to the right, it says max drawdown. That means what was the worst peak to trough decline, the most pain you had to endure at some point during those 40 years. And it wasn't the only one, it was just the worst one, to get that 21.6% average return per year in Apple. 83%. So people who go, if I'd bought Apple 40 years ago, I'd have almost doubled the S&P 500 return. What a no-brainer. You had to live through an 83% decline. So imagine having $100,000 in Apple, you've made a bunch of money, and you go, wow, I've really done well. And then suddenly it turns into $17,000, and you have to be patient enough to say, I'm going to stick with it. And not only that, the 83 was only the worst. There were multiple other ones of 40, 50, 60, 70%. On this list is also Home Depot, 20.5% a year, but you had to live through a 76% decline at some point. Nike's on here. Sherwin-Williams is on here. Eli Lilly. It's a fascinating list that just basically shows it's so easy to look back in time and go, I wish I bought Apple or whatever it might be all those years ago. It's not just about buying it. It's about holding it through the periods of brutality, which that can be really, really difficult, especially as the value of what you've bought gets bigger. You put 10 grand in it and it grows to 100 grand. That's a little bit more real money. It turns into $1 million. Now it's real money. 5 million. Now imagine that falling 83%. That's tough to do. Real tough to do.
Which it's the same percent. It's just it hurts more when you put it in dollars.
Yeah, it really does.
Yeah.
Investing is hard.
Investing is hard. I just want to pull up one more piece on the S&P for 2025, just to look back at the last year. Then we'll move forward to 2026. But the S&P 500, this is from Creative Planning as well, hit 38 new all-time highs in 2025. Now, if that sounds like a lot to you and you're listening and aren't looking at this chart right here, 38 new all-time highs for the S&P 500 in 2025. Please bear in mind that 2024 hit 57 new all-time highs.
Wow.
And 2021 hit 70 new all-time highs.
Yeah. Yeah, I had the start to last year hamstrung the ability to get as many new all-time highs. It wasn't one of those steady up years for most of the year. It was we had to dig out of a hole starting last year. So, yeah, interesting.
Yeah.
Look at that. 70 new all-time highs in 2021. That's amazing. I don't think we appreciate that enough. Inflation. I want to show something that I thought was fascinating. This is from Budget Dog on Twitter.
Budget Dog.
Budget Dog. I don't know, just a Twitter handle.
It's a dog that can budget.
So this gentleman said, if the next 30 years are the same as the last 30 years, here's how much life will cost by 2055. A gallon of gas will be $16. A cup of coffee will be $28. A new car, $218,000 in change, which is amazing to me. Average rent will be $6,500 a month, and the average house will be $1.6 million. And that's just inflation of the last 30 years overlaid onto the next 30 years. And we kind of all know this intuitively, but again, when you put it in dollars, it's striking. And so we always talk about, we build financial plans, and one of the biggest, most important components is the inflation component, because people think, we're human. We think of our life in today's dollars. And if we're 55 years old, for example, there's a really good chance one or both of us, if we're married, is going to live to at least age 85. You got to factor for 30 years of inflation. That's this. This. You have to factor for that in your planning, or you're going to be taking a fixed income into a rising expense world.
That's a great way to put it. The new car stat is the one that jumps out the most to me. Not even the house one. The new car being $218,000.
Yeah.
Like prices of Lamborghinis and Bugattis today and whatnot. It's just think of what the luxury cars are going to be worth. They're going to be worth, like 900 to $1 million.
Exactly.
Oh my gosh. Cup of coffee, $28. You know what? You're going to have the average rent be $6,500 in 2055, maybe, if we follow this pattern that Budget Dog is talking about. And then you're going to have me, being the new, hey, I can't believe you pay that much in rent.
Yeah, you'll be doing that. You'll be on the other side.
Meanwhile, rents are, around $2,000 or whatnot today, and people who rented in the 90s are like, that's too much. It's just going to keep going. Rent prices should have just stayed the same from 1980 on. Why would landlords want to make money?
You live long enough, you become the cohort that you previously resented for saying those things.
If you live long enough, you see yourself become the villain. What movie?
Oh, it's got to be a Batman, right?
It's the same movie.
That's Dark Knight. I haven't seen
Yeah.
Dark Knight in a while.
Oh my
That's
God,
great.
watch it.
All right, we need one more Dark Knight reference before the end of the podcast.
I'll try. Go for 3. Go for the hat trick. So where would a lot of that inflation come from? I know we don't get very political on this podcast at all. We try to stay away from that in total. But government spending wouldn't exactly help it. And I thought it'd be interesting to see a chart showing the line items for the what the government takes in receipts and income and what it spends. And this is also from Creative Planning.
I always love
in
this
the first
visual.
2 months of 2026 fiscal year, the federal government took in $740 billion and spent $1.2 trillion. Don't try this at home, Creative Planning says. This shows the cumulative receipts, and if you're not listening, this chart shows the cumulative receipts, outlays, and surplus/deficit through fiscal year 2026, which I know we're not far into. But it basically shows individual income taxes, Social insurance, and retirement as the 2 biggest income sources for the federal government. And then interest, which is crazy. Interest and Social Security is the 2 biggest spending line items for the government.
I mean, could you put it down in dollar terms in most people's lives? Could you imagine if over the course of a year you made $74,000 from working, but spent $120,000?
Yeah.
Right.
Yeah.
I mean, it's like, sure, you could do that for a year if you had some savings, but to do this year after year after year is insanity.
I mean, take from this chart what you will. Like I said, we don't get very political on this podcast, but a crazy stat here, in my opinion, is look at the net interest being the second most expensive item that the government spends money on, which is well above national defense.
Yeah.
It's 3 items. Net interest is 3 items above national defense.
So basically, we've issued so many treasury bonds, bills, notes, and so on, and we have to pay interest on those. And we've issued those because the government's borrowing money to finance whatever. And now they got to pay the interest, and that's that net interest number. It'd be the same as if you had just a massive mortgage and you're paying mortgage interest, and it's your second largest line item in your own personal budget. I mean, you know, if you borrow money, you got to pay the interest. That's a shame. This chart is always makes it so easy to understand at the same time is kind of upsetting too.
That's all I had.
All right, I got one more screen share. So, if you reach a certain age, generally over the age of 73, it's varies based on birth year, and you have money in a traditional IRA or SEP IRA, simple IRA, most 401ks, the IRS is going to require you to take money out of it every year. For most people, it's called a required minimum distribution. And if you don't do it, you still got to take it eventually, and the IRS is also going to penalize you. So it's you have to take your required minimum distributions, your RMDs. Check this out. From December 9th of last year, so about a month ago, Fidelity says that 53% of their investors at Fidelity that are required by the IRS to take the required minimum distribution for 2025 hadn't done it.
Oh, so my goodness.
You are, 22 days or whatever away from missing the deadline, getting penalized, and still having to take it and pay taxes. And yet more than half of the people who have to do that at Fidelity hadn't done it.
I'm surprised they're allowed to release those numbers.
So for Fidelity, this data came from their self-investor platform. So what Fidelity is doing is basically saying, people haven't done this, and it's not our fault because you're a self-investor. You should know you have to do this.
Fidelity's not obligated to tell you got to take it.
Yeah. A lot of people don't think about it. So it fits with the listener question that I had, and it was about 401k specifically, because a lot of people know this about IRAs. Hey, if I have an IRA and I'm in my 70s, odds are I probably need to take a distribution this year, or I'm going to have problems. The listener question is, hi, Rick, I'm 73 years old and have about $1 million in a 401k where I used to work. So they left their work and left their 401k there. Does the IRS force me to take money out of that 401k at some point? And the answer is yes. In almost all cases, the answer is yes. Just because it's a 401k doesn't, in most cases, almost all cases, doesn't make you exempt from the required minimum distribution rules. So it applies to IRAs, pre-tax IRAs, but also most 401k plans. If you don't take it, the IRS is probably going to hit you with a 25% penalty. So if you were supposed to take out $10,000, they're going to hit you with a $2,500 penalty for not taking it, and you're still going to have to take it and still have to pay taxes. But just for missing it, for being part of this 53%, for example, that Fidelity's showing you, it's even if it's a 401k, you probably have to take it. So you have to be on top of these things.
Yeah.
You got anything else?
Or don't self-invest, and
Yeah, we find a lot of people become clients if they haven't before, when they start getting into those later years and they need that retirement planning. And part of retirement planning is making sure they take their RMDs. It's a big deal. It's important. It gets really expensive when you don't do that. I
had a recommendation. Let me think about it, though. I didn't write it down. You go ahead.
Yeah. So I watched have you seen this, F1 the movie?
No, is that with Brad Pitt? I really want to see that.
Yeah, it's good. F1 the movie. It was produced by Jerry Bruckheimer and a few others, but Jerry Bruckheimer is so great. Everything, I love everything he does. It was
He
directed
did Pirates
by
of the Caribbean, I'm pretty sure.
Yes, he did, which are fun. You know,
Yeah.
they made a few too many. You know,
Oh,
it's like Fast and
Yeah.
the Furious. How many of those are you going to make?
Yeah.
The director was Joe Kosinski.
You can
who I
never
feel-
make too many Fast and Furious movies.
Yeah, I'll still watch it. I know I'll watch everyone. Actually, as they went on, they got better. Like when I watched the first one, it's not good.
Yeah.
You know?
Yeah, I saw a meme the other day where it was the picture from Fast and Furious 1, and it said, "I'm old enough now to remember this crew back before they were flying to space and saving the world."
The one that cracks me up with Fast and Furious is the one, I don't know which number, but your memory's great. It's the one where they're on a plane that's rolling down a runway and they're having like a battle conflict sequence.
Oh, and the
for,
plane
like,
keeps going.
it's like a 25-minute sequence. That must have been the longest runway on the entire planet.
Yeah,
You know? It was directed by, this is F1 the movie. It's on Amazon Prime and Apple TV. You can see it on both. It's not just Apple TV, because I don't have Apple TV. If it's on there, I wouldn't have seen it. The director is Joe Kosinski, or Joseph Kosinski. And I didn't know this. He directed Top Gun Maverick. So, that's, you know, tell me that. I love that movie. I'm in. It's completely fictional, but it's a great story. It feels like Top Gun, but with Formula One cars. It's a little long. It's 2.5 hours, but it's worth it. Even if you break it up, it's fun.
I'm in. I'm sold.
Good,
I'll watch
good
that.
movie. F1 the movie. Formula One racing.
I'm sold. I'll watch that. I watched a good Netflix show. I believe it was Netflix, called The Beast in Me. Like a
Oh yeah, you
thriller-
recommended this to me. I still gotta
mystery
watch it.
thriller show. Pretty good if you're into mystery thriller TV shows. It's pretty good. It was short. I forget how many episodes, but it did not take me very long to finish. Watched it in that limbo, middle of nothing week in between Christmas and New Year's.
Yeah.
Yeah.
The week when everybody's supposed to be working, but nobody's working.
Yeah, you're just full of cheese and tired.
You're regretting bad decisions.
Yeah.
All right, good.
All right. Well, guys, just because we have video now doesn't mean we can't keep answering listener questions. So please keep submitting them. We're happy to answer any questions you have. Like I said, video up on our website. Spotify, not yet. Spotify, no video. Sorry. But YouTube, we will hopefully have soon. So I'll keep you updated on that. And everybody have a great rest of your day. Thanks for listening.
Bye, everybody.
The Capital Clarity podcast is presented by FA's Keith Wagner, AA, MS, Financial Advisor, and Rick Wagner, CFP, Senior Vice President, Wealth Management. This podcast is for informational purposes only and is not intended to be taken as financial advice. All opinions expressed are of the hosts and do not necessarily represent those of Raymond James. Opinions are as of this date and are subject to change without notice. Investing involves risk, and you may incur a profit or loss regardless of strategy selected. Prior to making an investment decision, please consult with your financial advisor about your individual situation. 2003 South Easton Road, Suite 100, Doylestown, Pennsylvania, 18901 267 742 3455. Raymond James and Associates Inc., member New York Stock Exchange SIPC. The S&P 500 is an unmanaged index of 500 widely held stocks that is generally considered representative of the U.S. stock market. The Dow Jones Industrial Average, DJIA, commonly known as the Dow, is an index representing 30 stocks of companies maintained and reviewed by the editors of the Wall Street Journal. Inclusion of these indices is for illustrative purposes only. Keep in mind that individuals cannot invest directly in any index, and index performance does not include transactions, costs, or other fees which will affect actual investment performance. Past performance does not guarantee future results. 529 plans come with fees and expenses, and there is a risk they may lose money or underperform. Most states offer their own 529 programs, which may provide benefits exclusively for their residents. Please consider whether the state plan offers any tax or other benefits. Tax implications can vary significantly from state to state.